In the last class, we have completed this illustration on depreciation. So, calculate the amount of depreciation and rate of depreciation under straight line method, written down value method, sum of the years digits method and all. In the previous class, I have completed calculating the WDV as well as the amount of depreciation every year and rate of depreciation every year under SLM method, and we have solved that here. This one, original value minus depreciation for the first year and goes on. And from this information, we passed the journal entry also in the previous class and prepared the ledger. Okay, so we have completed the preparation of the ledger also. In this class, I am going to guide you how to pass the journal entry in case of provision for depreciation model is created or provision for depreciation is created. Is that okay? So earlier class, the depreciation is directly adjusted in the asset. In this class, depreciation are going to be accumulated in provision for depreciation account, accumulated depreciation. These are the two models in accounting. In the previous class, we have completed this one. So in this class, my focus is to make you understand how can we use the provision for depreciation model. Let's see. Let's see. In the very first year, 0th period, we purchased the asset for 65,000. Year 0. You purchase the asset. Asset account debit to depreciation. The value being 65,000. And by the end of first year, we create the depreciation. Usually, we charge or we adjust the depreciation in the assets value. After the depreciation entry, assets value will go down. Under this model, provision model, the depreciation will be now accumulated in new account called provision for depreciation. Let's see here. So first entry is asset to cash or bank, sorry. Okay, purchased. By the end of first year, depreciation account debit and that depreciation is transferable to provision for depreciation account. The value being 15,000. And depreciation being nominal account transferable to the P&L account debit side. So P&L account debit to depreciation. Value being 15,000. For the next year also, we have the same. Third year also, we have the same amount of depreciation. Fourth year also, we have the same amount of depreciation. So we can simply repeat these things year after year. So year after year, these two journal entries are repeated for every year's depreciation. Later on, that will be adjusted by debiting to the P&L account. So we have done this. Is that clear? And the last year, we sold the asset for 10,000 rupees. On sale of the asset, you will collect the money, so bank account debit. How much you are getting? You are getting 10,000 rupees. The sale value of the asset being 10,000. Come on, tell me. What is the value of the assets? Now I am going to credit on sale. Come on, tell me. What is the value of the asset after these 4 years? What is the value of the asset by the end of 4th year? Come on. How? Huh? 65,000. The asset value will be always at original value. The amount of depreciation created every year not subtracted, not subtracting from the assets value, but it is accumulated in new account called provision for depreciation. So on sale of that asset means provision. If you are having the provision model, on sale, asset will be always credited with its own original value, and then the accumulated depreciation available in the provision for depreciation in the credit side. 15, 15, 15, 15. So the provision for depreciation will have around 415, means 60,000 rupees are accumulated depreciation on the particular asset. That will be now reversed. Provision for depreciation. Is that clear? Always remember, in case of provision model, you have to always record the assets at its own original value. The depreciation will be always recorded and accumulated in the provision for depreciation account year after year. Finally, you find any profit or loss. In the case of profit, that should be transferable here. Profit on sale, 5,000 rupees. This is what about the provision model. Now, from this you can prepare our past journal entries and ledgers. So I'm going to post that in the ledgers here. Okay. So in the ledger. What are the ledgers are going to be opened here? Asset account we need to open. Asset account. And we can open the depreciation and provision for depreciation. So here I open the depreciation account and provision for depreciation account here. Provision for depreciation. Of course, you can prepare P&L extract also to show the amount of depreciation available or recorded in the debit side of the P&L account. So in asset to bank, the value being 65,000. In the very first year end, depreciation. In depreciation, we have to provision for depreciation. And in provision for depreciation, we have by depreciation, value being 15,000. In P&L account, this depreciation will available or appear in the debit side as depreciation, as usual. In depreciation, by P&L account. After passing these things, what happens? You just close the books of account. 15, 15, it gets closed. In asset account, if I tally this, I will get the balance. By balance carried on. That balance remains unaffected as opening in the next period. To balance brought down 65,000. On tallying the provision for depreciation, 15,000, 15,000. Here to balance carried on 15,000, that becomes balance for the next period. By balance brought down. Okay. So we can prepare the extract of balance sheet as well as P&L account also. Okay. How this will appear in P&L account as well as balance sheet. Let's see. In profit and loss account, as well as how this appears in the balance sheet. In P&L account, the amount of depreciation for the year will be appearing in the debit side, will be shown in the debit side. In balance sheet, we have two assets, two values balance. One is asset balance, another one is provision for depreciation. I may simply post that in the balance sheet. So in your balance sheet asset, the value being 65,000. And there is a provision for depreciation that can be subtracted from here, provision for depreciation. Then the ultimate value being 50,000 rupees. Okay, that's how we can show in our books. First year is over. Repeat the same for all the remaining 4 years, remaining 3 more years. Let's see. And year 2, we have the depreciation. In depreciation, provision for depreciation here, 15,000. In provision account, by depreciation, okay, the value being 15,000. In P&L account, it should be debited. In depreciation, it should be credit side P&L account. That's all. Clear? So I have posted only the P&L account. In P&L account, for the second year, depreciation will be debited here. To depreciation, 15,000. Only the extract. On telling the other account, asset account, we don't have any adjustments. Whatever the opening balance you have now, that becomes as a closing balance for the next year. The value of depreciation is now accumulated in a new account called provision for depreciation. So here by balance carried on. This value being 65,000. Transferred to the next year as opening balance, the balance brought down. This value being 65,000. And we have balances in two account. One is asset, another one is provision for depreciation. So on tallying the provision for depreciation, we found that the balance being 30,000 rupees. So to balance carried on being 30,000. Here by balance brought down. 30,000. I am going to show the balances of these two in the balance sheet. Asset account. What is the value of the asset? The value of the asset remains at the original cost, which is 65. The depreciation on this particular asset for the 2 years, 15 plus 15, accumulated in a new account called provision for depreciation account. I am going to subtract that from here. Provision for depreciation, 30,000 rupees. Now the net of this value, WD value being 35,000 rupees. Second year is also over. Let's move on to the third year. In the third year, right. So we have depreciation. In depreciation, two provision for depreciation, 15,000. In provision for depreciation by depreciation, 15,000. And in P&L account, depreciation should be debited, and in depreciation, P&L account should be shown in the credit side. So this is clear. Over. In P&L account, I have to show two depreciation 15,000 rupees. In P&L account. So two depreciation for the third year, 15,000. Now finish off tallying the ledgers. Asset account, it has no other adjustment. So I close as it is. Whatever the opening I have remains as a closing. So by balance carried on, this value being 65,000. Becomes the opening for the next year to balance brought down, 65,000. On tallying the provision for depreciation, 45,000. That comes as to balance carried on. Rewrite here. Ledgers are having the balances. One is all about asset. So I take this to the balance sheet asset side, value being 65,000. And we have the balance in provision that should be subtracted from here, which is 45. The WDV of the asset being 20,000. So with that, we have completed the third year. Now we move on to the last year. In the last year, depreciation. In depreciation, provision for depreciation being 15. And in provision for depreciation by depreciation, 15. In P&L account, to depreciation, 15. In depreciation by P&L account, 15. On sale of the asset, on sale of the asset, is that okay? You collect the money. So bank to asset, the value being bank to asset, the value being 60, and provision for depreciation being 10, being 10. Okay. Bank is 10, provision being 60. Bank 10 and provision being 60. Clear? And we get the profit also. To profit on sale, 5,000 rupees. In provision for depreciation, here to asset, the value being 60. On sale, provision gets totally eliminated. Totally eliminated. Its value 60. On telling the asset also, it gets closed completely, has no balance. On telling the depreciation also, it gets closed. In case of profit on sale, this will go to the credit side of the balance sheet, so in P&L account. So profit on sale, this value being 5,000. What about in balance sheet? Asset value also nil, provision for depreciation also nil. Clear? So the final year we close the assets completely. You have to remember, under provisions model, whatever the accumulated depreciation we have for an asset, on sale of that asset, this provision is straight away transferable from provisions account to asset account. Provision account to asset account. Until the time that asset remains its own original value, all the depreciations are accumulated year on year in the provision for depreciation account. Is that clear? Yeah. Come on, make note of it. So let me have the ledger format for these two models comparatively. Okay. We'll see. In the very first model, depreciation account is adjusted in the asset account. In the second model, depreciation is accumulated in provision for depreciation. Provision for depreciation. Under the first model, we need to open asset account as well as depreciation account. No more account required. The depreciation account also not required, which is common for both. Predominantly asset account. Predominantly asset account. Under the next model, you have to open the asset account. Parallelly, you have to open provision for depreciation also. Provision for depreciation. Okay, so you have to open these two ledger account. Clear? So in the very first model, how the asset account may appear. In the case of second model, how the asset. Along with the asset, you need to prepare the provision for depreciation also. So parallelly, right? Let's see. Asset is a debit balance, right? As it is being debit, usually you start with opening balance in the debit side and closing balance should be in the credit side. Opening balance and closing balance. Whenever the asset balance is increasing, it should be debited. If the asset balance decreases because of the transaction, it should be credited. Isn't it? It's an asset only. Asset shows always debit balance B. If any further transaction happens that raises the asset's value, then that should be debited. Else, it should be credited. What are the transaction raises the asset's value? Further purchase. So if you purchase any assets, then the balance of the asset account will increase. Okay. That's depreciation. So depreciation reduces the value of the asset. Not only that, if you sell the asset, the value of the asset will decrease. So bank, in bracket sale. While selling, we usually get either profit or loss. Usually the sale price is not matching with the book value of the asset. We sell more than the book value or less than the book value. If you are selling more than its book value, then it's a profit. Profit gives a rise to the value of the asset, right? So it should be in the debit side. So profit on sale. Profit on sale. In case of loss, it should be in the credit side. Loss on sale. This one usually appears at the time of sale. Okay. The entire three transaction will come where profit or sale or loss on sale, one of these two may appear. Clear? That's how you can understand the logic here. Come on, tell me. At what value this opening balance and closing balance will appear in our book? At what value? Is it original value or WD value? WD value. Okay. Written down value. After depreciating, whatever the value you have for the asset will be the value shown in the balance sheet. WDV value. WDV value. Clear? WDV. Written down value. See, in this case, the asset value is always decreasing year after year. 50, 35, 25, later disappear completely. So under the first model, where the depreciation is adjusted in the asset account, the asset value will be gradually decreasing to the extent of depreciation year after year. The opening balance and as well as closing balance will always be shown at its own WD value. The depreciation is all about the current year depreciation for all the assets put together. Current year depreciation for all the assets put together. So what about the depreciation here under this model? This 15,000 is the depreciation for the asset for that year, current year depreciation, CY, I represent that being CY, current year depreciation. Clear? Then rest is very simple, Now we'll move on to the next model. In the next model, again, of course, assets being debit balance, so we start with the opening balance in the debit side, ends the closing balance in the credit side, closing balance, right? Whenever the balance of asset increases, that value will be debited. If the transaction reduces the value of the asset, it should be credited. Now, what increases the value of the asset? Naturally, purchases, bank account, purchases. What decreases? Sale. Is that okay? Bank. Sale. On sale, you either get profit or loss. If you get the profit, what does it mean? The value of the asset is inflated when you compare with the market value, so it should be in the debit side. So profit on sale. Profit on sale. If it happens to be a loss, it should be posted in the other side. So loss on sale. Loss on sale. Now the question is, will the depreciation reduces the value of the asset or not? Will the depreciation reduces the balance of the asset or not? Under this model. Come on. No, it will not reduce because depreciations are added in the provision for depreciation. So provision for depreciation will be inflated every year. The asset will appear at its own original value. Okay, opening value of the asset as well as closing value of the assets all are shown at its own original value. Clear? Then where will you show the accumulated depreciation? We have a separate account called provision for depreciation. That's a liability item or a depreciable item from the assets should be shown in the provision for depreciation. Here, opening balance should be in the credit side. Closing should be in the debit side. Is that clear? Now, the depreciation you provide for every year under this model is added to the provision for depreciation. It means you have to show here depreciation for the current year. This is all about the current year depreciation. Clear? Check. Here in provision for depreciation, initially we have opening balance, with that current year depreciation is added. You understand? You understand the difference between the earlier model and this model? So in this model, every year the accumulated depreciation will be inflated to the extent of depreciation of all the assets put together in this current year. Current year depreciation is added. When the provision for depreciation account will be reduced or cancelled? The provision for depreciation account will be cancelled on sale of the asset. On sale of the asset, all the accumulated depreciation on the sale of the asset is no more required transferred for the sale transaction. Okay, sale transaction. On sale, asset account as well as provision for depreciation both are going to be cancelled. So this is also cancelled, this is also cancelled. Clear? On sale. Because of that reason, any asset sold that will be transferable from here to asset account. Here, provision for depreciation account. What is called provision for depreciation? Provision for depreciation is nothing but the value of accumulated depreciation on sold asset. No more required is transferred. No more required is transferred. Is that clear? This is nothing but what? Depreciation, accumulated depreciation on the asset sold. Asset sold. Once asset sold, the accumulated depreciation, that asset is not required. So asset will also disappear. Accumulated depreciation on that asset also disappear. Then why do I get the balance? This is the accumulated depreciation for the remaining assets if I have anything in the balance sheet. If you don't have any assets in the balance sheet, you don't have the closing balance. We have 5 assets. One asset was sold. Then whatever the asset sold, no, for that any accumulated depreciation you have, no, that will be transferable from here to here. Clear? For the remaining 4 assets, accumulated depreciation will be available as a closing balance here. So on sale, you have to understand these are the items to be posted. These are the items. Okay. Profit or loss you will get. So compare between these two. Okay, both are similar, but one thing is different. What's that? Provision for depreciation is higher. This depreciation is nothing but the depreciation of all the assets for the current year. But this depreciation is all about the sold assets accumulated depreciation since the date of purchase to the date of sale. You understand the difference between these two? So provision for depreciation is different and depreciation is different. Clear? Here I have used the term depreciation. Here I use the term provision for depreciation. So you have to be very careful with this. Is that clear? This is the most important point to be noted. See, once you start with a chapter, understand what are the steps you have to follow, what is the format and all. With the logic, try to understand. To master that concept, you solve few illustrations. Once it is over, then you are master. Make the note of this one. So, in Singar Academy text, I have given in 3 or 4 pages itself all these concepts. If you understand that, you can solve all this illustration. See here. See here. So, first one is all about WDV model. Another one is original cost model. In case of original cost model, you have to prepare what? Provision for depreciation also. Okay, under WDV model, we start with the opening balance and closing balance, but these two balances are appearing at WDV value. Any transaction gives the rise to the fixed asset will be in the debit side. Any transaction reduces the value of the asset will be in the credit side. So bank purchases as well as profit and sale, and bank sale as well as the loss on sale and depreciation for the current year will reduce the value of the assets. I have just given the information here. In case original cost, we start with the opening balance and closing balance at its own original cost. Purchases gives the rise, and when it's all about sale, 4 items will come. One is sale value, that reduces the value of the asset. Loss on sale also reduces the value. Hereafter, the provision not required for that particular asset is transferred. Here it's a provision for depreciation on assets sold since the date of purchase. And if you get gain, that will be posted the other way. So you can post in one of these two. Is that clear? This set is all about the thing you have to keep in your mind while selling under this model. Is that clear? Here on sale, you have to understand these concepts. Okay. These things are going to be recorded. And don't forget to open the provisions account also, opening provision and closing provision. Whatever the current year provision will also be added every year so that the provision will be gradually increasing every year. When the provision will go down, the moment any of the assets sold, the provision is no more required, will be closed. So here, asset depreciation on asset sold. This will be transferable from here to here. Is that clear? I have given the format here. Hope now you'll be able to understand this format in much better way. Clear? Other model. See, sometimes you may use asset disposal account instead of directly selling. On sale, bank account debit to asset to profit. In case of asset disposal account, the entry being the asset supposed to be saleable is transferred to a new account called asset disposal account. Asset disposal account to asset account. Value being 5,000. Value being 5,000. Later on, the asset disposal is encashed. Further, the journal entry being you get the collection bank account debit to asset disposal. You get around 10,000 rupees on disposing this asset, but as per your books of entry, asset disposal has balance of rupees 5,000. The difference between these two is your profit, so profit should be credited in profit on sale account. Profit on sale. By clubbing these two journal entries, your ultimate entry is nothing but this one only. The entry will be bank to asset to profit on sale. Okay. In case if you are preparing the account under provision model, this also through asset disposal account the other way, where the asset is transferred to asset disposal account. So asset is transferred to asset disposal account to asset account. The asset value under provision model remains at its own original value, which is 65,000. On transfer of the asset to the asset disposal, the accumulated depreciation should also be transferred to the asset disposal account. So here, provision for depreciation. Provision for depreciation is nothing but disposal. Okay, means accumulated depreciation on the asset disposed, which is 60,000 rupees. Now this value being 5,000. Now you can encash the asset disposal. Bank account debit, you get 10,000 rupees to asset disposal. The value of asset disposal in our book being only 5,000. But we collected 10,000 rupees. As we get 5,000 rupees excess, that will be called as profit on sale. Profit on disposal of asset. Clear? Now, how this will appear in the ledger? So in your book, I have given these journal entries also in the last. Check. Okay. So I have given this one also as well as this one. Isn't it? So you can refer that. Now let me give the balance sheets. I will give the balance sheet here. Means format here. See here. Now under this model, the sale happens routed through asset disposal, where in the very first instant, depreciation adjusted in asset account, depreciation accumulated in provision for depreciation. These are the two angles. Asset account on sale of the asset, that one is routed through asset disposal account. So I open that one also here, asset disposal account. Under this model, you have to open asset account, provision for depreciation, asset disposal account. Asset disposal account. Now, under this, we start with two opening balance and by closing balance. All the transaction increases the value of the asset should be debited and decreases should be credited. Okay. When you purchase new asset, it raises the value of the asset. Bank in bracket purchases. Here, depreciation reduces the value. And in case of sale, we have a new account called asset disposal. So it is transferred to the asset disposal account. Here, asset disposal account. I transfer here to asset account. Is that okay? Now the sale happens in asset disposal account. So here, by bank. If you get any profit, that will give rise to the value of the asset. So profit on disposal. In case of loss, it reduces the value of the asset disposal. So loss on disposal. Loss on disposal. Clear? And what happens in case the depreciations are accumulated in provision for depreciation to opening balance by closing balance by closing balance. When the asset increases, should be debited. When the asset decreases, credited. Similarly, in case of provision for depreciation, opening balance should be in the credit side. Closing balance should be in the debit side. Okay. The asset increases on purchase. So, in debit side, bank, in bracket, I name this being purchases. And on sale, the asset will be transferable to the asset disposal account. Not only that, provision should also be transferable to asset disposal account. So this will come here to asset account and this will come here. Okay. Provision for depreciation. Accumulated depreciation on the asset sold is transferred. Current year depreciation will be shown in the credit side of the provision for depreciation. Current year depreciation. So once we plan to discard one of the assets at its own original value transferred to the asset disposal, as well as accumulated depreciation on the asset sold also be transferable from the provision for depreciation to asset disposal. Now go for collecting the money for disposing the asset. Bank account debit to asset disposal. On sale, if you get the profit, it raises the value of the asset disposal. So post that the value in the debit side. So profit on sale. In case of loss, it should be posted the other side. Loss on sale. That's all. Is that clear? Hope now you'll be able to understand this one. Format is complete. Format is complete.